Something strange is happening behind the scenes, and most people have no idea. While the world is distracted with headlines, two superpowers are fighting a quiet battle that could reshape the global economy. The pressure is rising, the alliances are shifting, and one unexpected move could throw everything into chaos. And even today, when the fighting looks calm from the outside, the truth is far more unstable. The current pause is not peace. It is only a thin, fragile truce that could collapse with the smallest spark. A single decision, a single tariff, or even a single political statement could push both countries back into a storm that affects every economy on Earth. The video begins at a moment when the speaker is clearly unwell, but even then, the urgency is so high that the conversation must continue. That alone tells you how serious this situation has become. When someone keeps talking about a topic even while sick, you know the stakes are big. And in this case, they are enormous. Because behind the US-China trade war is a bigger story, one that rarely gets told, a plan that reaches far beyond tariffs, imports, or global trade routes. This is a plan to reshape entire industries, redirect the flow of global money, and control the future of manufacturing itself. This video reveals how the U.S. is quietly working to weaken the Chinese economy in ways most people do not see. You will learn how Washington is asking its closest allies to fund America's industrial rebuild, not out of charity, but through a strategy that turns global trade surpluses into fuel for U.S. factories. Through this plan, countries like Japan, South Korea, and Europe contribute billions that strengthen American production while tightening the pressure on Beijing. It sounds extreme, but the officials behind this strategy describe it without hesitation: a worldwide network of partners pouring their money into American industry like a massive sovereign wealth fund. This is not a conspiracy. This is the actual direction of policy, and it is part of a broader design to corner China from multiple sides. And that is exactly where the story becomes even more intense. Because while many believe the trade war is slowing down, the opposite is happening. China is selling even more to Asia, Africa, the Middle East, and parts of Europe. Tariffs hurt, but they have not stopped China's expansion. Instead, Beijing has rerouted trade, reinforced partnerships, and strengthened its hold in regions that rely heavily on affordable Chinese goods. That creates a new problem for Washington. Sanctions aimed at China risk harming entire regions that depend on those imports. When the cost clashes with global dependence, enforcement becomes almost impossible. You will see how this pressure has pushed the U.S. toward a new strategy, one that goes beyond past attempts and seeks a deeper level of control. This includes building a strong defensive line across North America, convincing allies to coordinate tariffs, and forming a collective barrier against Chinese exports. And while it sounds straightforward on paper, the execution is filled with hidden tensions, disagreements, and fragile partnerships, because not every ally wants to take the risk. Not every economy can afford it, and not every leader is willing to gamble their country's growth for America's vision. In this video, you will understand how these decisions are shaping the global economy in real time. You will see how the U.S. plans to rebuild itself using external capital. You will hear how the strategy is affecting the nations caught in the middle, and you will discover how close this trade war is to restarting on a scale far greater than before. These are the parts of the story that rarely make it to the surface, the details that take place in diplomatic meetings, policy memos, and quiet negotiations between governments. You will learn the truth behind why the truce feels so fragile, why the uncertainty keeps rising, and why the world is still on edge even when the conflict looks quiet. You will see why every expert warns that one wrong move could break the balance, and why both sides are preparing for a long and unpredictable struggle. By the end of this video, you will understand the motive behind the U.S. plan, the role of its allies, and the hidden dynamics that are already shaping what comes next. So stay with us until the end. Each part of this story connects to the next, and missing even one detail can change the entire picture. The trade war is not a distant event. It affects prices, jobs, technology, and the future of global power. Every viewer deserves to know what is unfolding. Welcome to our channel, And if you are new here, make sure to subscribe so you never miss an update. When we talk about global investment flowing into the United States, the scale is far larger than people realize. Countries like Japan have accumulated enormous savings overseas through decades of trade surpluses. That money sits in foreign assets, bonds, and reserves, and the U.S. sees it as the key to rebuilding its own industrial strength. American officials openly say that this pool of foreign capital can be redirected toward U.S. factories, technology hubs, and manufacturing plants. To them, this is not simply investment. It is a strategic tool. Japan alone holds hundreds of billions that the U.S. believes can be reinvested into American production. The argument from Washington is simple. These allies depend on the U.S. military umbrella, benefit from access to the American market, and rely on the dollar-driven financial system. In return, they can help rebuild the industries that once powered the U.S. economy. This is why Japan keeps appearing in policy discussions. They have the capital, the stability, and the long-term interest in keeping the U.S. strong. And from the American side, the expectation is clear. These partners are not just friendly nations. They are economic engines that can funnel large amounts of money into America's revival. This steady stream of foreign investment is seen as essential for the next phase of U.S. reindustrialization. Factories require massive upfront costs, and new supply chains need years of development, so U.S. planners are leaning heavily on these allies to shoulder part of the burden. The idea is to use their savings to accelerate growth inside the United States instead of letting that money circulate elsewhere. As global competition intensifies, Washington believes this strategy will give them a decisive advantage. And while it may look like standard foreign investment on the surface, the intention behind it is far more strategic. The effort to build a coalition against China comes from a simple reality. The United States cannot contain Chinese exports on its own. Even after years of tariffs and political pressure, China continues to expand its reach across Asia, Africa, the Middle East, and Europe. These regions rely heavily on low-cost Chinese goods, machinery, electronics, and infrastructure projects. For many of them, shifting away from China is not just inconvenient, it is nearly impossible. That dependence makes any attempt at complete sanctions far more complicated than Washington expected. This is why the U.S. is pushing its allies to act together. A unified front would make it much harder for China to redirect its goods into alternative markets. Washington wants coordinated tariffs, shared restrictions, and a long-term strategic commitment across multiple countries. The logic behind this plan is clear. If China continues selling freely to most of the world, then pressure from the U.S. alone will never be enough. Beijing will simply shift its exports elsewhere, keeping its manufacturing engine running at full speed. But building this coalition is far more difficult than it appears. Many allies rely on Chinese trade to keep their own economies stable. Cheap imports lower production costs. Chinese machinery powers factories. Chinese components fill supply chains that are deeply rooted. Asking these countries to cut themselves off or restrict those imports is asking them to accept higher costs and slower growth. That is why the U.S. keeps calling for unity, yet sees hesitation across the board. Leaders know that without broad cooperation, sanctions cannot work. And they also know that cooperating too aggressively could harm their own industries. This tug of war between strategy and economic survival continues to shape global alliances. Each country must decide how far it is willing to go and how much it can risk as the U.S. pushes for a stronger and more coordinated response against China's growing export power. The Fortress America plan is built on a bold idea: create a joint shield that blocks Chinese imports from reaching the U.S. market. Instead of acting alone, Washington wants a circle of key partners standing beside it. Japan, South Korea, and India are at the center of this strategy, each playing a different role in slowing China's export momentum. But the heart of the plan lies closer to home. The U.S. wants complete control over the Western Hemisphere, which means Canada, and most importantly, Mexico must be fully aligned with this agenda. Mexico's role is far more complicated than it looks on paper. China has quietly expanded its presence there by building factories, assembly plants, and supply chains. These operations allow Chinese companies to manufacture goods inside Mexico and then ship them into the United States at low cost through USMCA rules. On paper, the products look Mexican, but the components, machinery, and design often come from China. This loophole has been active for years, and the numbers reveal the scale of it. While U.S. imports directly from China have dropped sharply, imports from Mexico have increased. At the same time, Mexico's imports from China have also climbed, a clear sign that Chinese production is flowing into Mexican factories before entering the U.S. market. For Washington, this defeats the purpose of tariffs. The goods cross the border with lower duties, but the supply chain still carries China's footprint. It is a backdoor into the American economy, and the U.S. knows it. This is why Mexico is central to the Fortress America plan. If Mexico does not close this loophole, the entire strategy falls apart. The U.S. can pressure Japan, South Korea, and India all at once. But if Chinese products keep reaching American consumers through Mexico, the shield remains incomplete. The challenge is not just about trade rules. It is about controlling the flow of goods across an entire hemisphere. The frustration in Washington keeps growing because many of the products entering the U.S. through Mexico carry Chinese components, Chinese machinery, or Chinese assembly work. On the surface, they qualify as Mexican-made, but the supply chain tells a different story. This undermines the entire purpose of U.S. tariffs. If China can move production to Mexico and still reach American shelves at low cost, then the trade restrictions lose their impact. That is why U.S. officials have been pressuring Mexico to take stronger action and impose tariffs on Chinese goods before they even reach Mexican factories. From the American point of view, this is the only way to close the loophole and restore control over the flow of imports. At first, Mexico's president signaled support for the idea. The political messaging was clear, and the U.S. expected rapid cooperation. But as the details became clearer, the resistance inside Mexico grew stronger. Economic advisors warned that the country depends heavily on low-cost Chinese machinery, electronics, and industrial inputs. Removing them or taxing them would raise costs across entire sectors. This risk goes far beyond trade politics. It affects wages, production, and national stability. Lawmakers saw the danger and hesitated. They understood that sudden tariffs could trigger higher prices and disrupt factories that rely on Chinese parts to operate. Business leaders went even further. They openly rejected the idea, warning that Mexico's competitiveness could collapse. Companies feared that if costs jumped too high, foreign investors, Chinese or otherwise, may pull out. Factories could slow down or relocate. Supply chains could break. The risk was simply too large for them to accept. As the pressure mounted, the government stepped back. What was supposed to be a fast decision turned into uncertainty, and the tariff plan was pushed to December. The delay reflects how difficult this choice has become. Mexico stands between two economic giants, and every move carries heavy consequences. Mexico sits at the center of a complicated economic trap, one that makes punishing China far more difficult than it sounds. The country relies heavily on Chinese machinery, components, and raw materials to keep its factories running. These imports power everything from car manufacturing to electronics production. If Mexico suddenly imposes heavy tariffs on these inputs, production costs would rise across the board. Factories that operate on tight margins cannot absorb such jumps. In many cases, paying USMCA tariffs of 25% on finished goods entering the United States may actually be cheaper than losing access to low-cost Chinese parts. That means even if the U.S. pushes for higher barriers, the math often does not support the idea. Mexican exports will quickly become more expensive globally, making it much harder for local industries to compete. This problem grows even larger when you look at the scale of Mexico's planned tariffs. The government identified more than 1,400 product categories that could be hit. This includes some of the most critical industries in the entire economy. Cars and car parts could face tariffs as high as 50%. threatening a sector that employs millions and forms the backbone of Mexican exports. Electronics and steel could face tariffs of up to 35%, a level that would crush production lines that rely on affordable imported components. If those tariffs go through, Chinese companies would simply shift their operations to Brazil, Peru, or other parts of Latin America where the barriers are lower and the business environment remains friendly. Foreign factories already operating in Mexico would also feel the shock. Higher costs would push them to cut production, relocate, or shut down completely. Mexico's massive $120 billion trade deficit with China shows how deep the dependence runs. The country buys far more from China than it sells, and that imbalance exposes the vulnerability of its supply chains. Tariffs do not just affect factories, they also hit everyday people. When the cost of imported components rises, the price of finished goods rises too. A tariff is simply inflation under another name. The same product that cost a certain amount yesterday will cost significantly more tomorrow, and consumers will feel that impact almost immediately. This creates political pressure, economic uncertainty, and public frustration. It is one of the biggest reasons Mexico hesitates to move forward with U.S. demands. While Mexico wrestles with this dilemma, the United States faces its own problems. One of the most alarming developments is the decision to skip the unemployment survey in October. This data is central to understanding the health of the job market. The Federal Reserve relies on it to make interest rate decisions, companies rely on it to plan hiring, and investors rely on it to judge economic stability. Without it, everyone is left in the dark. The decision to omit such an important metric raises concerns about transparency and stability. When the world's largest economy withholds key data, it becomes a warning sign for markets everywhere. The economic damage from the recent U.S. shutdown adds another layer of stress. According to officials, the shutdown caused 60,000 private sector job losses. These are not federal jobs, but workers affected indirectly by disruptions. The cost to the economy was around $15 billion every week, a staggering amount for a single political event. Worst of all, the hit to GDP could be as high as 1.5% in the fourth quarter. That is almost equal to the amount of growth the U.S. gained from massive AI and tech investments. If the underlying system weakens while big tech keeps inflating numbers, the stability becomes fragile. At the same time, the AI sector, which was seen as the engine of American growth, is showing cracks. The NASDAQ lost $220 billion in market value in a single day. Tech stocks dipped sharply, raising questions about how solid the foundation really is. Investors expect high returns from U.S. tech. If they stop getting them, they will move their money elsewhere. That is the nature of capital markets. The pressure becomes even heavier when you consider how much the global AI build-out will cost. To build data centers, infrastructure, and reliable power supply, at least $5 trillion to $7 trillion will be needed over the next decade. This raises a difficult question: where will the money come from? For the U.S., the likely answer is money printing, subsidies, and aggressive borrowing. The government may pump liquidity into the system, buy more bonds, and push down yields to allow companies to borrow cheaply. But this strategy takes time, and investors may lose patience. The deeper problem is competition from China. China's advantage in energy supply gives it a powerful lead in the AI race. The country dominates 80% of global solar panel production and 60% of global wind turbine manufacturing. It also receives cheap oil and gas from Russia, which keeps energy costs low and stable. This allows China to scale data centers and AI infrastructure at a fraction of the cost the U.S. faces. For the U.S. to match China's energy flexibility, it will need massive investments in the power grid, renewable energy, and fossil fuel capacity. These projects can take years. Meanwhile, China can move faster and cheaper, especially with the support of Russia's discounted energy exports. If China manages to close the technological gap with slightly less advanced chips but far cheaper power, the momentum could shift quickly. That is the core of Washington's fear. The race is not only about better chips, it is also about who can power them. All these issues, Mexico's dilemma, rising tariffs, supply chain risk, inflation, hidden economic data, shutdown losses, market volatility, and the AI arms race connect back to the same question. Can the Fortress America plan actually work? It requires allies to take financial risks they do not want to take. It requires Mexico to disrupt its own economy. It requires the U.S. to rebuild faster than China expands. Every part of the strategy depends on perfect coordination, and yet every part faces its own obstacles. As the pressure builds, the world watches to see which side gains the upper hand. Story is far from over, and the outcome will shape global trade, technology, and power for years. Viewers are encouraged to share their thoughts, leave a comment, like the video, and subscribe for more updates as we follow this unfolding battle.